Welcome, everybody, to the Tuesday edition of the Not Your Average Investor Show. Today, we are talking about a potential Airbnb bust.
Oh,
it is, Airbnb came down with these new regulations in New York City, big old crackdown on there. We're going to talk about that, what that means and what it is. Then we're going to talk about these predictions that are out there from a lady called Amy Nixon that's been predicting this for a while. She brings up some good points. I just want to discuss them with you, see what you think, and then we're going to draw some conclusions on the future of Airbnb and how not your average investors should think about it. My name is Pablo Gonzalez. I'm the host. With me, as always, is a man that I affectionately like to call GC because he's got the genius concepts, because he knows how to generate cash flow, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
hello, everybody. Great to be with you.
Great to be with you, buddy. And great to be with our phenomenal community manager. We call her MTM around here because she brings us the moments that matter, and because her name is Madison the Magnificent. Say hello, Madison.
Hi, everybody.
All right. And now that we got everybody in house here, we got everybody in house.
We do.
Super duper. Well, I think there's something special. Breaking news. There's something special happening today over at NotYourAverageGuy.com. Tell them what it is, GC.
We got ourselves a little flash sale today.
A flash sale.
Flash sale. That's right. We've been talking about this guide that we put together, and it's really dedicated to helping those who maybe haven't taken their first step investing in rental properties, or those who want to go from maybe 3 properties to 10, 20, 300 rental properties. We put it all into this class. It's called the Not Your Average Investor's Guide to Investing in Rental Properties Passively. And we have over 250 folks that have enrolled in the course. We charge $9.97 for the course. But when you got a little flash sale, you don't charge $9.97 anymore.
What you charge?
You know what you charge now?
What you charge on a flash sale?
You charge $99 for the flash sale.
$99.
Let's do our best like used car salesman impression right here.
It's not $9.97.
It's
not $7.97. It's not $4.97. It's $99.
What was that, Pablo?
One day only. These prices are so crazy. We're insane.
Oh my goodness, though. That was really fun. I think we should just break from reality and do that every once in a while, because I had a lot of fun with that.
I love the break.
All of us have an inner used car salesman in front of in us.
I definitely do. I definitely do.
Yeah. So we're really excited about it. I think this is a great opportunity. We've had a lot of folks that have reached out and said, I'm thinking about doing the course, guys. This is it, right? We're dropping it to $99. Everybody knows that we don't do that. This is the first time. The team's like, hey, I really want to do this. I really want to see if folks are going to take action and jump in. It's a great way to get people involved, help them take their first step. And I'm like, cool. Let's see what happens. So
NotYourAverageGuide.com. You go there, you see the course. It's going to say $9.97, but you're going to say nay. You're going to put in a promotional code and it's going to drop it to $99. What's that promo code, GC?
JWB99.
JWB99, because it's a $99 sale. Woo! Flash! Ciao! So yeah, if you've already taken the class, perfect opportunity to get your buddy on it, right? Like we always like to talk about this. It'll be 3 hours, really well, less than 2 hours actually.
Yeah.
Really, really well spent. Understand the fundamentals of this asset class, become well-versed in what it takes to be a passive investor in rental properties, whether here, there, anywhere. It's the frame which you want to look at the world at in order to ensure your success as a passive investor in rental properties. I know that we have other, there's like other courses like this sell for
a lot more than
$50,000.
Are we still there? Guy, Phil Swift? No,
I don't know.
Phil Swift. We can do our best Phil Swift impression too.
Okay.
But yeah, $99. Would love for you guys to take part in it. And it's today only. So you got enroll today, $99.
So NotYourAverageGuide.com, JWB 99.
JWB99 is the promo code.
JWB99. Don't pay that full price like a sucker.
No. Come on down and use car sales.
Pay that flash price. And that's not it, you see. If they enroll for the class, what do they get to be a part of when they join the show?
Roll call, baby.
Baby, this is insane. We got Chris Lee from Fernandina Beach leading us off. We got the early bird in the house.
Dean Curry.
We got the leadoff hitter.
With great reference, the leadoff hitter.
With great reference.
John Henning, of course.
John Henning. We got the MVP in the house.
Lee Bishop.
We got the ringmaster.
That is the mountain man.
Yeah.
No,
we got
Drew
the
Barnhill.
ringmaster.
Drew Barnhill. I'm a little switched up. We missed Christopher Lee from Fernandina.
No, we started with Christopher Lee.
Oh, goodness. I'm sorry.
Okay.
I'm not much of a host these days. I'm more of a used car salesman. So I got to get back into my.
All right. We got the ringmaster.
Drew Barnhill.
We got Robert Jones from Atlanta, Georgia.
Hey,
Robert Jones, what know? Good to have you.
well-
Hey, welcome to the show. Right? We got Gregory Collins with
There we go, Gregor. Nice to see you.
I like it. And of course, your favorite.
Billy Green, you know, when you did the ringmaster, it
It's
was
true,
the
it's true.
low
I
voice
threw you
of the
off.
mountain.
I threw you off.
And
I did the
got
mountain man
thrown
voice
off.
with him, you know. All right, who else we got? We got Danny Davis in the house, newly acquired Arkansas resident with a pig suey.
Yes, indeed.
You will not do it. Huh?
You know, it just doesn't feel right. If you're going to do it, I don't have to.
We got the Shaw man of the Not Your Average Vest Show community.
Nadeem Shah.
Nadeem Shah from the West Coast. We got our regulars, the second family of the Not Your Average Vest Show, Rosalind and Gary Riley from Murrieta, California. Ooh, we regard you. Who else we got here in the house? We got Big Papa in the house. I love it when he calls him Big Papa.
Pops, how are you, my man?
Greg's dad. Always good to have you in here. We got the first family of the Not Your Average Vest Show, the matriarch and patriarch, Ken and Carolyn Moline. Ooh, we salute you. Who else we got in here? We got the real estate maven from the mountains of Colorado.
Leslie Wilson.
Leslie Wilson in the house. Who else we got? We got our own boy, Hervé Francois.
There we go.
With a What Up JWB fam. Good to have you in the house, Hervé. Oh, the patron Santorios from Northern Virginia.
Michael Santorios.
Michael Santorios. Good to have you.
You want to recognize Gregory. Gregory said, dang, $99 I'm buying. So that's fantastic, Gregory. Welcome to the club. Welcome to the club.
Way to take advantage of this one-time flash sale. We got Marilyn Cotterman from Homosassa, Florida.
Home of the manatees.
Home of the manatees. This is where the manatees swim. Always nice to have you, Marilyn. Nice Dolphins win on Sunday, if I might say so, Marilyn.
Dolphins cheerleader, Marilyn Cotterman.
As a Dolphins cheerleader. Our favorite name to pronounce, Aaron O'Neill. Into the lights. Aaron, good to have you back on the show. As always, we got the better Greg. Greg number one.
Greg Stone.
Greg Stone
The
from
better
New Jersey.
Greg.
We've missed you, the better Greg. I've been stuck over here with lesser Greg. We got Lita Song in the house from beautiful Minnesota.
What a sweet, beautiful name. Lita Song.
Lita Song.
I feel like there's just birds that are just chirping wherever Lita's around.
True. She does sound like a Disney princess for sure. Steve Faghetti in the house. Good to have you, Steve. Welcome back.
Steve. Well,
please put the link in the chat. Madison, if you could help us out putting that link in the chat for Steve. We got Horace Allen saying, good day, folks. Is that a new name?
that is a new name. I know Horace. I spoke to Horace not too long ago. It's really nice to see you on the show, Horace.
All right. Good to have you, Horace. Hope you make it a habit hanging out here with us. We got Cody Adams in the house, the mama bear of the community. Cody's in the house.
There we go.
Tony D in the house. Tony from Brooklyn. Lewis Hudnell from SF says I should start listening. Tony D, we have another Tony D. So I'm glad we got two Tony Ds. We got Tony D2 from Brooklyn in the house. Tony, good to have you.
So nice to have you, Tony.
Epic Brooklyn name, Tony. Hey, Tony from Brooklyn. I like it.
Tony D.
Hey, all right. Amir Yunan from LA. Amir, good to have you here as well. New name. We got some new names in the house.
Another party, Amir.
Hope you make this a habit. And somebody that's not a new name, Victor Mudrick from Virginia, hanging out with us.
Flying. Great to have you on the show.
Good to have you. Okay, so GC, that's the roll call. Let's get into business. I think every time we talk Airbnb, we get a pretty big crowd, so we don't want to disappoint today. This was inspired by the headlines from last week, right? New York City crackdown on Airbnb. Let's just talk about what happened in New York City. I don't know if you read, I did. Basically, in New York, there's always been these stipulations that hosts need to register with the city. And if not, any stay that's under 30 days is only allowed if the host is there, and you can have only a maximum of 2 guests, right? So basically, like if your buddy's coming over, you're allowed to do it.
Right.
You're not really allowed to short-term rental Airbnb model like it's used to. And that's always been there, but they had never enforced it. And now they're going to enforce it. So basically, all of these hosts need to comply. If you have a unit that you rent out and you're not staying there with the person, that's no longer in compliance with these rules. If you're not going to be there or whatever, it's more than 2 people, not in compliance with these rules. Hosts must register for approval, and any violator will now be charged $5,000, and the platform Airbnb will be charged $1,500 per violation.
Yeah.
Reason why they're doing this, according to the headlines, is number one, Airbnb is largely being held accountable for there's a lack of housing in New York City. And this idea that folks are turning the available housing into like mini hotels and doing this stuff, they don't really see that lightly. They think they're making the problem worse, this lack of housing, and they don't appreciate it. Also, residents of these buildings are complaining, right? Like people are coming there to have like a bachelor party. They don't want to have them in their backyard. So it's built up all this demand on top of the fact that, of course, the hospitality lobby has always been trying to like fend them off, right? That's not new. And what's happened thus far, there's been 3,250 applications by the time of this publication from the New York Times. Only 257 of them have been approved.
Wow.
Yeah. Yeah. So not a lot, not a high approval rate. The article itself, though, estimated that 7.5 thousand of they estimate that there's about 13.5 thousand units in New York City. Only actually 7.5 thousand of them will be not in accordance. So what it means is it has been operating an Airbnb unit in New York City. There's a very, very high likelihood that they will no longer be able to count on that as the model for their financial model for investing. What do you think?
Well, I went back and I listened to this same topic. We did this same topic in April of 2023. We also did it last year as well. And the biggest thing to me was just the tone of the investment just in April of this year versus the tone of this investment now. It is like the bottom has dropped out of short-term rentals. If you remember in April, it was questions about, Gregg, how come you guys aren't going stronger and stronger and stronger into short-term rentals? How do I leverage JWB to acquire short-term rentals? All of this. Now there is significant headwinds here. And there are regulatory headwinds, which we're talking about here. We haven't yet talked about how does this asset class perform in a recession as well. That still is hanging out there right now. But, when we talked about this in April, when all of you guys were saying, guys, Gregg, why don't you make this a bigger part of what JWB does? Why aren't you going stronger into this? My response was, listen, it sounds good on paper, but I've been around a lot of things that sound good on paper. One thing that this has not gone through is it's not gone through hard economic times. It's not gone through a recession. It'll be interesting to see how this performs in tougher economic times. And we openly talked about how the regulation risk for short-term rentals is much more significant than long-term rentals. And so it was one of those wait and see approaches. Now, JWB has made a significant investment in Airbnbs in short-term rentals, but we do that with our own money. And the reason that I do that with my own money is because I think about what happens if I had put these investments together and sold 300 short-term rentals a year ago when it was on fire, and now had 300 clients or 150 clients that now got this news about New York City and said, oh no, when's that happening here? Oh no, what happens when a recession's coming? Oh no, did I do the wrong type of investment? So what I think about this is there are assets that have been proven to perform decade after decade after decade. You want to throw an eviction moratorium at long-term rentals. You want to throw a housing crash that experienced in 2007 through 2011. You want to throw all of that stuff at long-term rentals, and it wins. It wins because it's a critical need. It's a critical need. Short-term rentals are not a critical need. And so when you step away from critical needs, you have additional risks that come into play. And so, I think we sort of talked about this early on. A lot of this is coming to fruition. And I think a lot of investors who just jumped on the craze and just went very deep into short-term rentals have some additional risk that they're going to be faced with.
Yeah, I totally agree. And we're going to talk more on overall economic picture for Airbnb and kind of like the state of those investments and the statistics behind it, which are pretty eye-opening. But for me, I think of two things, right? Like I think of the idea that you build your relationships during the hard times. Like, you know what's good for you in hard times, right? And like, whether it's relationships or does your business make it through hard times or whatever, that's when you find out if you're really in it, right? Like, because for the last 14 years, times have been really good in the economy, right? So a lot of things have looked really good. NFTs looked amazing for a hot minute, right?
Bitcoin.
Yeah, all that stuff has flashed, and yet none of it has truly been tested in a hard economic time for something that I would want to count on 40 years from today, right? A long-term relationship, right? Not a short-term flip right? Whether we're flipping houses or I'm flipping Bitcoin or whatever, sure, I can go speculate on that if I want to think short term. I can even Airbnb had a really nice moment in the sun as well. You know, we just haven't seen it in hard times. And for me, when I think of investing, I think of how much can I make in a really safe piece of pie that's going to be there later that I don't have to think about, right? Like how much can I put to work for me without really having to think about it? And this news, you know, this makes me think that I'm glad I didn't think Airbnb that way, right? Like short-term investment, cool. Testing it, cool. I think Jamila Bonahum puts that she did great during the COVID setback, right? Like for sure. I'm glad you made your cash flow and your money there. I would just be reassessing it right now, kind of is a thing, right? Of like how long I want to be in that.
Well, so let's talk about why short-term rentals did great then, because, you know, and I'm sure for Jamila, right? I'm sure she bought back at a time when home prices were lower, but interest rates were a lot lower then. Yeah. And so the fundamentals of that asset probably haven't changed, right? Yeah. You're probably going to be doing great, whether it's long-term rentals or short-term rentals. And it seems like you did really great on the short-term side, but you know, there was a special kind of combination of things that happened a few years ago that really set up perfectly. And I listened to, it's Amy Nixon who was speaking on this, right? Yeah,
Amy Nixon has like coined this Airbnb bust kind of like terminology. She did it about a year ago, and she still believes that this thing is coming. She just thinks that she was early because of a couple different reasons. If you want to get into,
well, and she just talked about how it was just a perfect storm. There was revenge travel on the minds of all of us after going through COVID. That there was this huge explosion of travel.
Yeah, revenge travel, and still couldn't travel abroad. So revenge travel that had to be targeted to domestic travel.
Yeah. So that coupled with extremely low interest rates that we're probably not going to see again before prices had gone up. But here was the big thing.
Yeah.
It was the fact that Airbnb was able to operate ahead of regulators. They experienced this time in the sun where regulation just couldn't catch up. Yeah. And now that is not the same. You know, New York City is not the only place that has really tamped down on Airbnbs. I mean, I just know in Atlantic Beach, Florida, here in Jacksonville, and Atlantic Beach is basically Jacksonville here. They put a rule in place where you can't have Airbnbs for less than 3-month stays. Yeah. You know,
how recent was that? Because I remember trying to book an Airbnb there not that long ago.
For Atlantic Beach?
I couldn't find it, but I just didn't know how long it's been going on.
I know it's been a while because when I first moved back to Atlantic Beach, I was looking, because I was building my house and I was looking for an Airbnb to stay for 2 weeks or a month, and I couldn't do it. I had to do it for 3 months. So that was over 4 years ago. So it's been longer than that. Yeah. You know, so these municipalities have not 100% been on board with Airbnb in the beginning. They had to try to figure out how to adapt to this new entrance into the market and whatnot. But now regulation is here. Yeah. And it's in many, many parts of the country. So, you know, what we talked about early on was that, you know, the tenets of the basic tenets of buying a property and getting great debt in place are there, whether it's short-term or long-term rentals. We talked about how a smart strategy was to be buying assets based on long-term rental numbers, making sure it would work for long-term rentals. And then if you wanted to give it a shot for short-term rentals, more power to you, right? That was the prudent approach. However, especially over the last year, and there's still a lot of people that are kind of hooked on Airbnbs, the numbers just don't work as well when you've got 6%, 7% interest rates out there. They still can somewhat work depending on how much income is brought in from them. But now you throw this regulation risk on top. And that's where the real risk is for those, you know, have invested in this, or maybe you got an adjustable rate mortgage and now your demand is going down because of regulation risk. So it's just not as clean and simple. It's kind of like, you know, I get asked about like student housing. Yeah. Right. Student housing is very similar to long-term rentals that we focus on here. It's just a little bit different. It's, you know, you can make more money, make more income. It's just more work, or there's more expenses. So it's a variation, right? Short-term rentals, the same thing. Meaning it's not the same thing. It is the adjacent thing where you can make a better, you know, cash flow on it. But what are some of these other risks, regulation risks? So it's not the same thing as long-term rentals. Long-term rentals is proven. These other ones, maybe not.
Yeah. To me, I'm going to talk about the stats and Amy Nixon's takes and these kinds of things just in this New York article, this New York scenario, right? Because Matthew Edwards is saying, while he's had some fluctuations although we've seen some fluctuations in one of our 3 short-term rental markets, our 3 short-term rental markets continue to perform well. And that's not surprising either, right? Like, I think there is definitely a scenario where right now you are performing well. And there's a scenario where in the future it may perform well. The thing that freaks me out is the regulation piece, right? Yeah. Like the idea that new asset classes have new risks, right? Like I talk about categories all the time. A new category creates other categories, right? So Airbnb as a category, the short-term rental market, the way that Airbnb designed it as a category is a new category. And that created a whole ecosystem of like Airbnb property management and Airbnb like listing optimization, this whole like little industry. It also created a new category of risk, right? It created a new category of regulatory risk that you have to think about that you may not think about in other asset classes. So that needs to be on your radar, right? Like if New York City can do it, what other municipalities are going to follow suit, right? Precedent is a really, really strong thing, is the first thing that I think about. Second, it's this idea of the residents that live around it don't like it. And there's lobbies that are going to be fighting this nonstop. Like, at some point, you got to make the decision of if you want to continue to fight City Hall or be on the side of that and not. And that makes me think of the idea of, man, we talk about vertical integration here all the time, right? Like we talk about the idea that JWB is the only truly vertically integrated turnkey rental property investing company, because you don't just like acquire the land, build the property or renovate it, fill it with a tenant, manage the property, manage the asset. You're also deeply ingrained into Jacksonville and deeply ingrained into the politics of Jacksonville and the interests of the public of Jacksonville. And it's, like I just see a big difference between investing in something that your neighbors don't like or investing in something that the city et al. Is essentially begging you to do, which is provide affordable housing for the workforce class in a rapidly growing city that desperately needs it. I just, how much do you want to fight with stuff, and how much you're going to fight means how active it is, how much share of brain it's going to take up for you while you're sleeping or not sleeping, or, like how long you're going to want to be in it. Yeah.
I mean, anything attached with making homes more unaffordable right now is facing significant pressure.
Yeah.
Right. I mean, the home price affordability crisis that we have across our country is real, and there really, really smart people and lots of dollars are going to ways to figure out ways to make homes more affordable. And so unfortunately for short-term rentals, they're on the opposite side of the mark that you want to be on when it comes to home price affordability. When you have housing stock that otherwise would go to long-term residents who would pay a lower dollar per night rate and would be more affordable, you would increase supply for affordability. If you don't have short-term rentals, in theory, then they're going to look at short-term rentals as a quick thing. We could just put a regulation in and create how many more housing units in New York City?
Another 7.5K?
Yeah, another 7,500 or so, housing units. But that's what they're thinking. And, while that may not exactly be 100% true, whatnot, that's the thought. Anything that can be done to support affordable housing is going to be pushed through. And the quicker, the better, because the housing affordability crisis generally does not have quick fixes. We have to build our way out of it, and building takes time. So that's a real risk. And, I think the shift, though, has been the perception of Airbnb. It went from being something that was like freedom and the sharing economy and something that everybody felt really good about. Now, communities do not feel that way. They see noise, parties, they see trash, they see parking problems. And they're like, I don't really want this as much. Some communities are more forthright than others. But so 2 things: you're not on the right side of home price affordability, and you're also not, generally accepted in communities as much as you originally were. And you could see more regulation following down, especially as a major market like New York has just done.
Totally. And I'm gonna add to that. First, I'm gonna say Abby Faludin is asking for the replay link. Cody, if you could go to where we're playing it live on YouTube and get him that link and share it with Abby, that'd be greatly appreciated. Cody is here to help us out. She's the mama bear of the community. And second, also Matthew Edwards is talking about a way to subvert regulations is to pivot midterm rentals, meaning turn them into 1 to 3 month rentals. We're going to talk about solutions of like, once you're in this, if you're already in it, what are your options, right? And that's definitely one of them. But you mentioned this idea of the community turning against you. I would elevate the conversation to say your target demographic is turning against you, right? Like Airbnb is a millennial business model, right? Like millennials have been their super consumers. It is founded by millennials. When first started, millennials saw this thing as a low cost option, which millennials love, community driven, which millennials love, and generally helpful, right? Yeah. Like it filled a need when it first started. And then at some point, and by that, I mean, 62% of Airbnb listings have started after 2020. Drew said in the chat that it was 50%. The stat that I got from Amy Nixon is 62% have listed after 2020. So this explosion of Airbnb listings, along with ongoing sentiment and ever, have essentially turned it into the anti-millennial business model. Because now millennials, if you look on TikTok, people are talking about Airbnb is too expensive. There's all these like hidden fees. This is not transparent like we're used to, right? So like it became expensive. It's become anti-community, which millennials are very anti-community. And it's now seen as a problem that's taking away housing options for them. So it's not just the local community, it's your customer base.
Interesting. Yeah. Yeah. I mean, the perception has totally changed.
Yeah.
And it's investors jumping in as well. I mean, investors sometimes have a negative perception. It's just simply investor activity. You know, it's kind of like, you know, at some point people realized that Airbnbs were run by investors, and there's a lot more investors today that own Airbnbs. And I wonder if there's that, you know, sometimes we face negative sentiment just simply as investors there. You know, I know New York specifically talked about how they wanted to sort of get to I don't know if they said this exactly, but in essence, they wanted to get to the heart of what Airbnb was in the beginning, which was, you know, that shared community, which is why they make the host be in the home, you know, and you can't have more than, I think, 2 guests. Is that it?
That's what they're doing in New York. Yeah.
Yeah. So they're trying, in essence, to get back to what Airbnb was in the beginning and have it be that shared economy without so much investor activity, because you can then open up more supply to be long-term rentals or homes available for sale.
Yeah, totally. It's a big difference between being seen as, right? I think we were just talking about it earlier today. There is a general sentiment in younger generations about like being a landlord is kind of like a sinister activity, right? Like some see it that way. I know when I was bringing it up at that conference, I was in San Francisco, like, yeah, but doesn't mean you're a jerk. I'm like, no, not necessarily, right? There's 2 different types of landlords. There is the type of landlord that is, you know, really, really opportunistic and will drive whatever they want for their bottom line without thinking of anything else. I would put the term slumlord in there, right? Sure. Like that's where that comes from. You could put you know, to me, coming from Miami, the developer that just like came into Miami to like develop something 3 years later, flip it and get out of there with all their money. I put that guy in that pocket.
Right.
People are putting, you know, the Airbnb investors into that because they see it as contributing to this problem. And then on the other side of it is what I see our community as, right? Like I see in our community, I remember when COVID happened, the number one questions that were coming through this chat was, are my residents going to be okay? Is there anything we can do for them?
Yeah.
Right. So starting with that intent, starting with the idea of like, you're in it to truly provide housing for people that need it, and you want to create the best experience possible, akin to like an Airbnb superhost.
Yeah.
Right. Like you're an Airbnb superhost. You're trying to provide the best experience possible.
Sure.
You're on the good side of things, most likely, right? As long as it's not against regulation. But, you know, our community of people that are doing that. And then you add another extra layer of workforce housing and good conditions for affordable homes that serve a population that makes less than 80% of the average median income
Right.
is always a necessity, and is especially a necessity in a growing metro area where locals already feel like things are getting too high priced. And a lot of the stuff that's being built new, like what's happening in downtown and whatnot, isn't really for that demographic. That's going to be a higher priced offering of what's coming. So they need places for the people that serve those locations, their teachers and stuff like that to live, right? Like two different types of landlord outlooks, two different type of landlord dispositions and goals at the end of the day.
100%. I think if I boiled that down, in any type of asset or investment, any type of relationship, it's tough to paint with a broad stroke, right? It's tough to say that every one of this person is this, or every one of this person is that. It's the same with investors. There are bad investors and there are good investors, and I think if I boil it down, there are some investors that go into an investment thinking that I have to win. In order for me to win, somebody else has to lose. In order for me to win, somebody else has to lose. That's how a lot of investors think. But then there's a beautiful section of the population, a lot of investors that think like we do, which is we believe that we can have triple wins, all right? Our residents can win because they have a much better home and a much better living situation, a much better service from their property management company they can get anywhere else. They can win. They can be in a home long-term to build community as well. They can win. Our clients, of course, can win because we're able to beat what they could earn on a return on investment in other places like the stock market. And then JWB can win as well. And if we do a really good job of all of this, and we do this enough, communities can win. Our entire Jacksonville community can win, and median incomes can rise. And I really believe, we really believe that we all can win together. And there's those types of investors in real estate and other places as well. And I want to be surrounded by those types of investors. And that's why I get to hang out with you guys, because you guys are as well. But I wanted to make it really clear that when you invest with JWB, you're a part of the solution, especially when it comes to home price affordability, right? And we just ran some stats and some numbers on the type of building we do and how rare it is. First of all, when we build new construction homes, which we do, 71% of our new construction homes are affordable. They're at 80% of adjusted median income or below is what it's necessary in order to afford that house. 71%. I don't know of another builder where 71% of the homes that they build are affordable, right? So that's a part of what you guys are investing in. 94% of the homes that we manage are affordable by that same metric. So 94%, we manage over 5,000 homes now. So your homes are contributing to solve home price affordability. You're on the right side of this. We won the 2017 NEFPA Developer of the Year for affordable housing, Northeast Florida Builders Association. We were recognized at that. And then my business partner, Alex, is the vice chair of he was asked by Mayor Donna Deegan to be the vice chair of the Housing Affordability Transition Committee. So he was able to influence how we are going to make things more and more affordable. And so I don't know if we've shed enough of a positive light on all the things that we just do here naturally as a part of this model that you all are a part of, which is solving home price affordability here in Jacksonville. So it's really nice to be there, to be around people that believe that we can win together with residents. And that's what makes this type of investment so fun.
I love it, man. And I think it's an underreported story. And I think Tara puts it well, like she keyed in on it. Well said. We can all win in this real estate investing game, right? Like I think the developer, investor, landlord that is looking for how the most people win, good developer, investor, landlord, developer, investor, landlord that's thinking, how can I win and how can I get the most out of this thing and whatever, not the best, right? So I think it's, and it's as simple as that, right? Like, are you looking beyond just your own victory? I like that. So in the big scope of things, GC, you kind of teased a little bit of this, right? But 62% of units have been listed after 2020. So way increased competition. Also, during that time, we benefited from the work from home explosion.
Yes.
Which meant that people were traveling and working. People were moving to cities and renting Airbnbs before buying somewhere, right? Like it was the peak of that. Right now, companies are pulling back on that, right? Like that's not, work from home is still around, but is not as prevalent as it used to be, right? So that's going away. there was the domestic travel revenge spend, right?
Right.
There was this moment where we had all been bottled up. We can't go international. So, we traveled domestically, right? So big buoy for them. Right now, international travel is actually doing very, very well.
Right.
And you can get great deals on domestic flights. And millennials, the target demographic, had a ton of cash because they had stimulus checks and there has been a student debt loan moratorium,
Yeah.
which is another giant topic in our generation of paying back your student loans. It's been a long time since people have had to cut those checks on a monthly basis. That's starting back up again.
Yeah.
Right. So it's up against all of these headwinds and all these trends that propped it up for a while. And now those trends are going away. So conclusions of the conclusions that I'm drawing is it's a new, more difficult era for Airbnb investors going forward, right? Like if I was thinking about an asset to get into, this may not be the best time to like start getting into that. And I don't necessarily think it's going to be a bad time for Airbnb stock investing. Like I think the company has a lot of ways to pivot, but I think as the person that's going to be the hotel tycoon that I thought I was going to be at some point, I'd be reconsidering that. Right. So that's number one. If you're thinking about investing in something, if you want to take a long, hard look at that, you're on board with that, I would imagine.
Yeah, I got some slight variations to what you're saying, but yeah.
Okay.
Should I go in there?
Should I go with all my conclusions and all your conclusions, or go conclusion by conclusion?
That's what I was going to do. I was going to write down my slight variation,
Okay.
and then I was going to take my turn.
Okay.
When you
Cool.
were ready.
You take your turn, buddy. Second, if I am already an active investor, right, like Matt is, and who's clearly doing well with this stuff, I would be 100% pressure testing my assumptions, right? Pressure test my occupancy assumptions, pressure test my cost and maintenance assumptions, right? If all of the demand for Airbnb goes around, what happens when the availability of Airbnb property management companies go around? How financially solid is that property management company that's been tested, right? Like the whole ecosystem is about to get pressure tested.
Okay.
So I would really be looking at what my costs are going to look like in the future and what my revenue is going to look at the future, and I would mess around for worst case scenario to see what that looks like. I would reassess regulation risk. I think the denser the city and the more powerful the hotel lobby, the more risk you have, right? Like I would think of Bill Shields bought like an Airbnb property on like the Santa Fe River. I would say that has a very low regulation risk because you're like a rural Airbnb. Airbnb in Jacksonville Beach, higher regulation risk, right? I would be my assessment. I would take a long, hard look at that. And then I would look at, hold on, I got my notes over here. Yeah. So
I was like, man, are you firing these off right off the top?
Yeah, I'm pretending I'm looking at you, but I'm really looking at
up.
And then what I would consider is, like Matt said, do the numbers pencil out for converting to medium-term rentals or long-term rentals, right? If just for peace of mind, I would think about, can I convert this stuff and how quickly can I convert this stuff in order to go as passive as possible? Because my prerogative is to be a passive investor. I have enough dealing with my company. And if those numbers don't pencil out, I'd be very strongly considering being first mover advantage on housing prices are still high. Housing supply for homes is still really, really low and demand is high. I would be looking at exiting, doing a 1031 and getting into long-term rentals. That's my takeaway.
Okay. All right. That's good stuff.
Give it to me.
Well, so, all right, here's the first question that I just kept asking myself as I was listening to your wonderful, eloquent points there. Why did you get into this investment in the beginning? Some people got into this investment thinking that it was going to be passive, that it was just going to work, that it was like long-term rental properties. If you got into this asset thinking that, you are finding out that it's not that way. It was not that way before there was regulation risk, though. I wanted to point out, and we didn't mention this on the call here, but I wanted you to know that I'm speaking from experience. So JWB invested to the tune of about $5 million. We invested in about 40 short-term rentals here in Jacksonville. So we've done this over a number of years. And so we have our money in the game as well. So when I think about why did you get into this game, right? We got into this game. We wanted to test the theory of, are you really making better money? And when you factor in the amount of hassle, is it really passive? Is it really passive? And what we found is that, you did make some more money on some of our units. Some we did not make as much money as we would make for long-term rentals. So it kind of is property specific, but it's a lot more work. So I keep going back to this original question. If you're thinking about short-term rentals, or you already in short-term rentals, why did you go there? Was it because you said, hey, listen, there might be more work here and I might really have significant upside and I want to take that journey? Then great, you made the right asset. But I think for a lot of people, they didn't think that. They thought it was going to be simple, passive, not have to think about some of these things. And that might be, a great awakening for many people, True. Right?
Yep.
Then that leads me to, if you have an asset that is proven over and over and over, and it's better than the stock market, and 60% of all Americans own stock, and roughly a third of them have already said they wanted to invest in real estate, why not take that money and put it in something that's simple and has been proven to work over and over and over again, and to not have to worry about these additional variables and risks. So that's where I think long-term rentals wins in that scenario. Not right for everybody. There are some who want to take higher risk, high reward, and that's where short-term rentals can play. So that's just kind of overall what I'm thinking. The first point you said, hey, listen, maybe I don't want to be a hotel tycoon like I was thinking a few years ago. That goes back to my experience with this and with many others, is that this idea that we were going to make a whole bunch more money by owning short-term rentals compared to long-term rentals really hasn't shaken out for us with our money. So regardless of this regulation risk that you find and the changing perception that we're finding now, if you run your numbers, you might have decided not to become the tycoon, even if there was no regulation risk, because is it really better? I don't know. It leads to your next question, which is pressure testing. I think knowing your numbers is really important. The way to win here is the same thing that we said back in April. And it's the same thing we said probably a year and a half ago when we were doing the show on this as well. There's nothing wrong with short-term rentals, in my opinion, from an investment perspective, but it needs to be viewed as, I'm going to make sure that it works for the long-term rental. I'm going to make sure that the cash flow works for long-term rentals first. And then if it does, and I want to give it a shot for short-term rentals, then go ahead and knock your socks off, right? You can easily convert a short-term rental into a mid-term rental or into a long-term rental if it works for long-term rentals. So that same kind of thought process will play here too. Know your numbers, run your numbers as they are for short-term rentals, also run your numbers for long-term rentals. If you need help understanding what it's going to be from a long-term rental perspective and you're in Jacksonville, reach out to my team. We'll tell you what it'll rent for long-term, and then we'll be able to help you out there. You mentioned reassessing regulation risk. I think that's a really good topic. You gave the example of Jack's Beach, and in Jacksonville overall is very favorable when it comes to Airbnbs. So I don't think Jacksonville is going to be the next shoe to drop as far as large regulation, just based on the way things have been regulated so far. And I'm not hearing anything along those lines.
Cool.
And Jack's Beach actually is a great place to be able to rent out short-term rentals, compared to like an Atlantic Beach, which is right next door and has more regulation risk. So certainly not off the table, but I wouldn't single out Jack's Beach as one that has a high regulation risk. The last one though. So talk to me about this. So you got this asset. Let's say you bought this short-term rental 3 years ago and you had some success with it. Maybe it's not the winner today as it was back in the day, and you got to convert it to a long-term rental. Why do you think selling's the right move? Like, think about this. You probably got an interest rate that's, 4% or so. You did so much work to acquire this asset. Depending on what market you're in, it's probably going to appreciate over the long haul. Like, why is your next move to sell it?
I probably could consider that further, right? Like I would say, if I was to add nuance to that statement, is if I had this asset and I could convert it to long-term rental,
you do that first, of course.
That I would do that first.
Yeah.
If I couldn't, I'd be worried about what experience I'm going to get out of that thing, right? Like what are my if I can't convert it from short-term to long-term or medium-term rental, and I can't find a professional property management company in my market that is really awesome, that aligns with my incentives and has 100 employees and has people dedicated per metric instead of per property.
Yeah.
I would say I just wouldn't want the headache is my thinking.
Yeah. If it's way too much of a headache because you can't get effective property management because you live in a different part of the country than Jacksonville.
Yeah.
And you don't have an opportunity there. I could see that, right? That's kind of standard. If an asset isn't working, even though it delivers a better return on investment, but it's creating a hassle in your life.
Yeah.
No matter what the return is, it's probably not worth it. So I'm with you there. But I just wanted to shine light on the fact that like, our job as investors is to acquire income producing assets. And if there was a time in our country where it was like so beneficial to acquire those assets and have that debt in place that was so low, especially 2 years ago, 3 years ago, right? Your interest rates were so low that if it's me, and let's just say that I had to go into a negative cash flow position, but I still had 4% debt on this investment property, I would still go negative cash flow.
Interesting.
Because the value of having 4% debt in place for the next 30 years is so critical there. So that's the only caveat there. Okay. At the end of the day, like you're saying, if you don't have a way to make this a positive experience for you and you hate this investment, you can't find a good, property manager, selling is a good move, but like hold on to the asset. Let's just get this in our heads that like acquiring the assets using other people's money is like most of the battle. So hold on, and it might be even if you go negative cash flow for a few years, I think I'd probably still do that.
That makes a lot of sense.
Yeah.
And maybe there is some kind of like refinancing you can do. Maybe there's some equity you can pull out of that thing anyways, right? Yeah. Okay. Yep. That's cool. You want to hit on, so needless to say, if you are thinking about selling it and doing a 1031, go to chatwithjwb.com, right? Like you would be able to move that asset and move into something that's going to make 10% for you over the next 30 years, do really, really well, professionally managed, all that stuff. If you have a short-term rental in Jacksonville that you're worried about, you can go to chatwithjwb.com. If you want to convert it to long-term property management, they can take that over for you. So just throwing all that stuff out there, that if you have questions about this and you want to pressure test this, I would assume your team is able to like help you pressure test it, right?
Oh yeah, 100%.
Yeah. So if you need a buddy, if you need a real estate expert to help you pressure test, that's a good call. Chatwithjwb.com. I want to answer a couple questions here real quick.
100%. Let's do it.
All right. Lee Bishop. I don't know if this is a question, but he says New York is eliminating another investor class for houses that are not generating tax in New York. Investors for that asset class are going to reduce their inventory and create a glut of surplus of more not moving houses.
So he's saying, a class of houses that are not generating tax in New York. So I guess I would have assumed that the Airbnbs were creating tax revenue in New York prior. I'm not 100% certain on that, but so you're saying that they're eliminating that and then they're creating more housing supply for long-term rentals, which is the intention for sure for New York houses. So yes, I concur.
Okay. All right, cool. Lita asked earlier, does Airbnb consider as a short-term rental? So does that mean short-term rentals aren't performing in New York? That's right, Lita. So short-term rentals is under 30 days. Airbnbs, the majority of bookings, I would assume, is under 30 days.
Yeah.
And that's exactly what we're talking about, is this idea that all of these are going to be disqualified and not be able to be a viable business model in New York. So those people that bought those properties with those assumptions will have to figure something else out.
Yep.
Michael asks, what do property managers charge for short-term rentals? What do you guys?
I think we don't do property management for short-term rentals. In fact, just to let you know our kind of evolution with our investment, when we made that decision to invest about $5 million in our short-term rentals, the thought was we'll try it out for our own property management to see if it's something that we wanted to scale for other investors. And we decided that we don't want to do that. Short-term property management companies charge 20% of the rents that are collected. So they charge a higher rate, but they do a whole lot more work too. Yeah. And it's more in the hospitality field. So that's generally about what they'll charge.
Cool. Nancy DiNucci has a good question here. We're talking about holding on to the assets. She asked, well, what about seller financing to help keep your interest rate if you're in one of those situations?
Yeah, it might be a great option. I mean, we're getting into kind of like a very minute type of situation where you've got regulation risk, and what that is doing is taking away sort of an income stream for yourself. So now I guess kind of where I'm going is seller financing I think could be a great opportunity here. But when I say seller financing, for a lot of people, it usually doesn't work well for our types of investors, just because, if you're doing seller financing, you have to wait to get the capital, and you generally have to give an interest rate to that person who's in essence waiting to pay you. That is, it doesn't have to be low, but it's certainly not as high as 10% most of the time, which is what you can earn on your money here. So that would be my thought, right? If you are doing seller financing, you can keep the asset, but then think about what are you charging on your interest rate for that person to be able to do seller financing run that opportunity cost versus what you could do with your money if you received that money up front, putting it into a different asset. So, at the end of the day, I think you probably keep the asset as long as it still works for long-term management and long-term rentals, and you have good management. Outside of that, maybe seller financing works.
Related to that, Vic Mudrick has a question of, have you guys ever done seller financing and sold to your residents?
No.
Okay. Greg Truncalis has a clarification. Did I understand this correctly? If we have rentals, we can move it to JWB to manage?
100%, Gregory.
Yeah, they do that all day, Betty.
100%.
Chat with JWB.com and
Yep.
you find out about that, right? So JWB essentially manages Northeast Florida, right? Like within 40 minutes of this office, something like that.
Yep. Over 25% of the homes that we manage are from clients that didn't actually purchase from JWB. So a much larger percentage than many people think. So yes, that is an option for all of you out there.
Only in the Jacksonville area though, because you're not leaving here. And then Drew had a question. Did Atlantic Beach just make a 3-month rental requirement? Though that's been around for a while, right?
It's at least 5 years.
Buddy, good show today, man.
Thanks, dude.
I love these not your average insights where we take a look at what's happening in the world and just put the GC perspective lens on it, man. I always learn something new, and we always get the best questions from the community when we do this
100%.
stuff. So a lot of fun. It never goes unnoticed that you're spending an hour here to ask these great questions here. Oh, the patron Centaurus comes in with last minute interesting find. The city with the most amount of short-term rentals in the United States is Miami Beach, Florida. According to AirDNA, there are over 3,400 Airbnb listings with 50,000 people in Miami Beach. If I was living in Miami, I would totally 1031 into Jacksonville property, especially because I'm freaked out about climate change. So anyways,
Yeah, true.
so that being said, this was awesome. This Thursday, we have an investor story, and it's a unique investor because he happens to also be the controller of JWB.
If you want an investor who knows as much as you could possibly know about JWB, it would be our controller. His name is Rich Neal. He is a friend of the show. This will be his second time on the show.
He was one of the OG
He
guests.
was an OG.
Yeah.
I'm really interested to
Yeah.
see his perspective on just how our community has grown.
Oh man.
You guys are going to knock his socks off. He hasn't been tuning into the show.
Yeah.
And so he's going to be here. We're super excited to share his journey being a controller with JWB, financial professional. He didn't know us before he became the controller, didn't think the way that we think here, and, has a really successful portfolio with JWB that, it's great to see your own people make the decision to invest with you as well.
If you want to know how an investment performs here, ask the bean counter that invests here himself. I guarantee you he knows the numbers. And I agree, man. I can't believe so. He was one of the first 8 guests that we had on the show.
Yeah.
And that was 3 3/4 years ago, GC.
I looked at our episode number. It was number 333 is the last one that I just looked at. Over 300 shows. Guys, this is crazy. And these are not easy shows to attend in the sense that they're done in the middle of the day, an hour, Tuesday and Thursday, and you guys keep showing up. And so thank you so much from the bottom of our hearts to be able to do that. I'm excited for Rich to see what we've all built together.
Yeah, me too. I'm excited to see the community show up en masse. And I got one little piece of advice. Don't be average.